Hey there. So I talk a lot about the story behind your numbers, about how that story can tell you things like you're not going to be able to pay your suppliers next month, or you need to hire somebody, or maybe your cost to acquire a lead is too high. All of those things are excellent things to know when you're in business. And so that's why I promote the idea of small business owners being able to read their own numbers and understand the story that's hidden there, as well as chatting with me to understand the deep dive into your financial statements, what's really going on the little nuts and bolts in there. So, hi Darcy, hi Juliana. So I want to go over quickly, not so quickly, but high level, how do you read financial statements? Because they're not intuitive to read and they need to be explained. In fact, sometimes we need to put in notes to the financial statements so that we understand what's going on in there. They're not intuitive. So, what are financial statements? That's a good place to start. Your financial statements are two statements, sometimes a third one. The balance sheet, your income statement, and sometimes a cash flow statement. Show us the belt. I love it. I can't really do it because I'm sitting, but you get the idea, like a wrestling belt, because I'm killing it up here. So you have your balance sheet, which is your assets, which is what the company owns, the liabilities, which is what the company owes, and then the equity piece, which is the difference between the two of them. And you can think of equity as the piece that the shareholders actually own of the assets. So like if you have a mortgage on your house and you keep paying the mortgage down, then you keep growing your equity in your house or on your house, right? So the piece that the bank owns is a liability. The piece that you own is your equity in your house. So it's the same thing in a corporation, that the assets are partly owned by the bank or whatever it is, whoever you owe, and the rest of it is owned by the shareholders of the company. So your balance sheet is a snapshot in time, basically. It is a life-to-date statement, which means it records everything from the very beginning, the very birth of the company, all the way to the end. Not the end, but today. It's today. So that statement can give you an idea of how easily the corporation can pay its bills, for example. It can tell you how leveraged it is, which means how much of the assets are purchased with debt versus with equity. And you can get a lot of really great information from that statement. The income statement is the one that we're a lot more familiar with. It shows your income and expenses over a given period of time. So unlike the balance sheet, which is a life-to-date statement, the income statement is periodic, which means it goes from one point in time to another. We usually run an income statement for a month or a quarter or 6 months or whatever. It's no longer than a year. A year is your max for your income statement. And then after a year, your income and expenses get squashed down into one line called net earnings, which moves to the balance sheet. Net income is not net income. Your income statement is the more day-to-day statement that a small business owner would look at. So it's showing you, invoices that have gone out. That's your income. It's showing you what it took to be able to make those sales, which is your expenses. This statement is different than cash, which I have talked about in previous videos. I'll find one of those to link to. So I'm not going to chat about it now. But your income statement can show you, the relationship between sales and expenses, which is a really important relationship to understand as a small business owner, because if you double your sales, for example, we see a ton of sales coaches or salespeople that are selling themselves and saying, hey, do you want to double your sales in the next 3 months, or triple your sales, or whatever it is. But the problem with that is that you could double your sales, but if your expenses more than double, you're going to be in trouble. So we really want to understand, how much does the next sale cost me? Because we can't make money without spending money. And if the next sale is going to cost more than the amount of money that we can bring in, then we probably don't want to make that sale. So just really understanding the relationship between income and expenses is probably the biggest thing that you can take away from the income statement. If you're a small business owner, that's what I would be looking at. So the third statement that I mentioned was the cash flow statement. That statement is the bridge between the income statement and the balance sheet. It's describing net income through the movement of cash. So what does that mean? It means when you create a sale, you have an invoice, you don't always get paid at the minute that you generate the invoice, right? If you're a retail store, then you probably do, but if you were a service-based company, for example, then maybe not. And so you have this income, but you don't necessarily have cash in the bank. And the same thing with expenses. Maybe you got a bill from somebody, and so you've generated an expense, but you haven't necessarily paid out the money to that bill. So you have income, you have an expense, but cash has not necessarily moved in or out of your bank account. And so the cash flow statement describes that movement of cash. And it's a really important one for small business owners to be looking at, because it tells you where your money's going, basically. Sometimes we have expenses on the income statement that are not cash. So if you depreciate assets, that kind of thing, you don't actually pay out any cash for that. However, if you were to purchase an asset, you wouldn't be able to expense all of it because you're capitalizing and depreciating it, which I'm sure I've talked about before. Anyways, but you've had a huge outlay of cash, so that would go on the cash flow statement. So I feel like I'm getting into the weeds here because I love this stuff and just want to talk about all the little details. But that's not useful for you, so I'm going to stop. If you have any questions about it, I'd love to chat with you. I'll put my link to book a call with me in the description. But more exciting, I'm super excited about it, is I set up a 5-day email course series, video series. So you can subscribe to that, and then every day for the next 5 days, you're gonna get a little video and a little article about each one of the statements. And in the case of the balance sheet, I break it up into sections. So that one's actually over the course of 3 days, because that's a big one. And I am so excited about this. I just sign up for it. It's great. I don't normally go nuts like this over my own stuff. Normally I'm like, it's okay. But this one I'm excited about. So yeah, sign up for that if you're interested to learn more about how to read your financial statements. And it goes into how to actually get some really great stories out of your financial statements. I talk about ratios and how to understand that relationship that I was talking about between income and expenses. Because this was a very high level overview. So yeah, definitely go sign up for that. I've left a link for it in the description. If you want to leave in the comments for me what the number one thing is that you wish you knew about the finance piece of your business, I'd love to know that. And maybe I can give you some pointers as to how to get that out of your financial statements. So with that, I'll see you tomorrow.